All right, what's up, everybody? I think we're live. I think we are live. I think you should be able to hear this. Good evening, everybody. Welcome back to this new stream and welcome back to yet another FOMC meeting or Federal Reserve meeting. We're going to do a full live stream. We'll take a look at the press conference and in general, I'll give you my thoughts during the speech. For those who missed the actual interest rate decision, it's as expected. It's 4.5%. So that's, well, it had a bit of a market reaction. I mean, obviously, you can see right now volume is very high, and that will continue to be that way in the next hour or so. So that's definitely going to be true. So far, we've held this 382 fib right here at 96,100. So I'd say that's pretty good, but ultimately the main thing that we're going to be watching for, while we also keep an eye on the 30-minute time frame chart for Bitcoin, is the speech and what will be said during that. All right, so that's what we'll do. First, we have a couple of minutes here to reconnect. So how's everyone doing? Is everyone having a good week trading? Good week in the markets? It's been a relatively quiet week for me. I mean, last week was very up and down. I had one very good trade, and then after that it went a little bit downhill. Still ended in profits though, but could have been much better. And this week I missed a trade on virtuals by like 0.005, so that sucked a bit. But today I took a little bit of a scalp short on Ethereum. Excuse me, which I still have partially open right now. Outside of that, I have no major positions, and ultimately I think, tonight you can definitely do some gambling because there's going to be a lot of volume, there's going to be a lot of volatility, but it will be gambling, all right, unless you're very quick, right? So unless we're watching the press conference, and you hear something that's either very hawkish or dovish. Dovish would be good, hawkish not so much. And then you could also take a trade which is not gambling. I mean, if Jerome Powell speaks about quantitative easing, just open that 100x long, all right? And as soon as you can. And I just ate some pizza, so I might have to refill that water. What's up, Boris? How are you doing? Ryan, welcome. Team Dave, welcome to the stream. Hank, Harlem Fashion. How's everyone doing? YouTube? Yeah, EOS went very well. EOS was one of the trades I had last week that I closed at a loss, relatively minimal loss, but still at a loss. And then if I would have held it, would have been amazing profits. But of course, hindsight is the best trader I know. Yeah, it was quite visible that EOS was quite good. Ryan, that's listen. Ryan, I appreciate it. I appreciate me being there in your dreams, but it's a little troubling, all right? And hopefully it was in good spirits. What did it look like, Ryan? Maybe it was really my house. It could be. What's up, Taylor? What's up, Philip? A Chill Guy. I stopped watching Chill Guy last week after it had broken out. I think we talked about it earlier, right? I think we talked about earlier a Chill Guy about 2 weeks ago or something, if I remember correctly. Then it did very, very well, but right now I think it's kind of I think it's gone. But I have to be fair to you. I also haven't really watched it that much. All right, let me already look up the stream, and I also will tell everybody that we're live. In a moment, so we actually have a couple of things to do here. Give me a moment real quick. What's up, Stefan? Greetings from Berlin. Great pronunciation. What's your favorite nightclub there, man? I've been to Berlin a couple of times. I've visited some clubs there. Pretty good. But there's some crazy ones out there as well. Kenzie, welcome to the stream. Ragu, of course I remember you. Blanket Bulb, welcome to the stream. Z-Book, welcome. Biruk, welcome. Pepe Ramirez, welcome to the stream. Welcome, everybody. Like I said before, but for those of you who missed it, hope you're all having a great week. Hope you're all having a great Wednesday today. My Wednesday was quite busy, so I haven't been around the screen for too much, but hopefully that helps. Looking at the markets through some fresh eyes right here. All right, let me quickly send out some reminders that I'm live throughout some groups. And then we are good to go, and I'll take a look at the live stream, and I will check up on the I'll check up on the check up on the stream. Wow, great, on the chat. That's what I wanted to say. My taskbar is not working, so that's absolutely amazing. There we go, and there we go, and then also on X, and then we're done. And then we can get to the live stream real quick. I'll grab some water first. So for those of you who are tuning in for the first time during these streams, basically what we'll do is we'll take a look at the live stream, all right, the press conference part, and we'll take a look at that together. I'll mute myself, or I'm not sure if I'll mute myself. Let me know if I should. But I'll probably mute myself, and then every time Jerome Powell says something that's interesting for us, for the markets, I'll unmute and I'll tell you if it's interesting and why it's interesting. So if it's bullish or bearish, I should say. So that's what we'll do. I think that's the best way to go about this. We have about 1 minute left. I already have the live stream right here. I think the connection is good enough to do this. I hope so, at least. Yes. Alexander, welcome to the stream. Lore Manuel, welcome to the stream from Iraq. Wow, that's I don't see that often, but welcome to the stream, of course. Hawaii, also don't see that often. Welcome, Roman. I almost don't believe it. Listen, Mr. King, Berghain next bull run, I will not get in. I will definitely not get in. And I also don't really, I don't really want to stand in line for 4 hours to get in. I stood in line until 3-4 a.m. for I think Sisyphus, and that was already like I got in. I was there 3 hours and I was already dead. So not really my stuff. But maybe we can do that. And welcome everybody else to the stream, of course. I mean, I'm seeing some names here, some familiar names. Welcome to the stream. Glad to have you all here. We're almost starting with the live with the press conference. So let me get ready. All right, be right back. All right, so let me see. There we go. This should work. What's up, everybody from the UK? Tunisia, welcome. Flacco from Tunisia is here 4 times, as you can see. Hi from Mars. Wow. How's the colony doing? Oh, there we go. Do I have audio? I'm not sure if I have audio. Oh yeah, I do have audio. Let me put on the captions here. Subtitles, please. A little bit bigger. Font color. Yellow. Font size a little bit bigger, like this. Okay, this should work. There's audio right now, or at least there should be audio real soon. Why is there no audio? Oh, there is audio. Let me know. Should I mute myself, or should I mute myself and then unmute every time it says something interesting?
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Pretty bullish. Pretty bullish.
I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me.
So far, so good.
Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, bearish, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
Nothing new, at least.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment.
Slightly
the
bearish.
effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week.
All of that was slightly
Throughout
bearish,
this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
Yeah, so
everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
I agree to, sir.
Thank you. I look forward to your questions.
All right, let's quickly summarize this. So basically, nothing major. All right. In general, it started off relatively positively. He also gave he gave a bit of a positive impression about the inflation. And the way they see it right now, and the way that the employment is still very good. So it started off relatively bullish. That's also, I think, why we rallied up slightly here. But then he talked about the tariffs, and he said something similar last time. So what Boris said is true. Yeah, we'll get to Jerome Powell in a moment, Nelson. Sorry. But what he said about the tariffs, he said last time too. So that's true. But still, it seems like he's suggesting that they're not going to change the monetary policy stance, which at this point of time the interest rate is still quite high, unless they actually get more certainty, and that is slightly bearish, right? Because for how long will they keep the interest rates relatively high? If that's for a very long period of time, that's not great. And if they keep this quantitative tightening going on, it could not be great. But let's tune back in, and then I'll tell you when anything major is being said. So let's tune back in.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmerose of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning.
So basically not much of a change in stance from the last time. And it's also unlikely that they'll have a different stance in June, depending on the data, of course.
Need to be in a hurry. Does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
You know, as I said, we are comfortable with our policy stance.
Zen guy,
we think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry.
Thank you very much,
We feel like it's appropriate to be patient. And you know, when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants
Taylor,
or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and you know, as that develops, and I can't really give you a time frame on that.
Janelle.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft
Team
landing,
Dave,
and what
either
does that
trade
look
deals
like?
or just better
Well, let me
data,
say,
right? But more data
mean,
for sure.
So let's look back and see where we are. So to go through 2024 up to the day, we've had you know, unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, you know, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now, and we have an expectation,
it's a bit of a nothing
conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is, but. In any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Should we talk about tariffs, Harish?
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
Like a lot of different
first of all, we don't
see
that yet, right? We have 4.2% unemployment, good participation, wages behaving very well, participation, I mentioned it at a good level. So, you know, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point.
We just want some quantitative
what does that mean in
easing.
practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
That's all we need. That's all we need to pump.
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. We're not in this situation, but the situation is if the two goals are in tension.
Yes,
so
as expected,
let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time, so again, difficult judgment to make, and not one that we face today, and we may never face it, but you know, we have to be keeping it in our thinking now.
Godzilla, I think that's most likely indeed. I don't
Thank
think
you.
We'll see much
Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under.
Last question, then we'll talk about the markets real quick.
Should the Federal Reserve be cutting rates at all this year?
Follower, nothing major has been said.
I think you have to just take a step back.
But the market is reacting.
There's
a bit of a bearish reaction right now in the markets, as you can see.
You know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't. And we just don't know. Until we know more about how this is going to settle out and what the economic implications are for employment, inflation.
Okay, and we're done. All right, let's do a bit of a recap here. So in general, the market is moving here. Let me delete all these ugly key levels. The market is moving here, but when we're talking about the speech, nothing major was said. All right, basically he said what he says most often, and that is that you know the monetary policy stance and the changes of that depend on the data, and at this point of time they want to wait for more data before they're going to make a change. All right, so you could say that's bearish, because obviously we want better monetary policy, right? We want less quantitative tightening. Maybe we even want quantitative easing, and we want lower interest rates, which goes hand in hand, of course, but still. And the fact that he says we're not going to do that, first of all, general economic data, so inflation rates, PCE price index, unemployment, or just employment data, and tariffs, trade deals, and everything around that. Right, so that essentially is slightly bearish, but that's also what he said the last FOMC meeting, right? So therefore, does it really matter that much? Probably not. All right, and I would argue that even though we see the markets pulling back right now, that's more of a technical move than a fundamental move, because I think ultimately, is it? Let me see. I think the quality is not that great. Let me know. How's the quality? I have a notification that the quality of the stream is not that great. But let's continue. So slightly bearish, but like I said, ultimately I don't think this FOMC meeting today matters too much. Well, I think the Wi-Fi is very, very bad right now. Let me see if I can fix that. Is it okay? It's okay, because I cannot even load up my chart. But that's okay. Boris, please don't send me a mouse, please. I already have mouses in my house right now. Oh, it is buffering. Yeah, no, I think it's I think it could be better, but I'm trying to get more connection here. The FOMC meeting, it's a bit of a non-event, right? Nothing that was said wasn't said before, or we did not know before. All right. Now, if I would have to say, gun to my head, bullish or bearish, I would say bearish, right? But that is as much as I think that he said some bearish things. As much as I said, or at least I think that technically we have a lot of imbalances here to the downside for Bitcoin. So therefore we can expect a pullback. Right, so I'm obviously biased because I think technically we will still pull back first before we can actually see some more bullish momentum. So I'm biased, and I don't think anything he says was bullish enough to prevent that. All right, so therefore I have a slight bearish bias on Bitcoin right now, and as you can see, it's no sound. What is that all about? There should be sound. Yeah, I'd reload it. But a lot of people right now have no sound. It should be better right now. Let me know if it's better right now. Yeah, the Wi-Fi right now is not great, guys. My apologies. My sincere apologies. How is it now? Is it better? It's very mixed. But the audio, no, Bruno, I think some people are not listening. I think some people cannot hear it. Because I'm getting some alerts here to the left of me as well from YouTube. YouTube is telling me that the connection is not great. So I don't think this sounds completely great, but I think we've heard most we need to know. So we can slowly end the stream here. I mean, like I said, I have a slight bearish bias on Bitcoin here. Most altcoins are correlated to Bitcoin, so therefore most altcoins will follow that as well. But that's for two reasons. First of all, I think the FOMC was not bullish. I don't think it was that bearish either, but because it was not bullish and we have all these imbalances to the downside, for Bitcoin, I expect at least a move further into this imbalance right here, between 96,000 down to 95,000. And then if we're able to hold 95,400, if we're able to get a strong reaction from that, then I think we can hold this stability up here. And from this stability up here, we have the chance to rally up higher. And if we're unable to get a strong bounce from 96,000, 95,400, then we can drop down into this balance down here. But that is something I will make a video about tomorrow morning. In general, I'll be back with new videos tomorrow morning. So I think that's what you need to know. All right. I don't think the FOMC meeting was that relevant. I don't think anything major was said, but purely technically, I expect Bitcoin to pull back a little bit lower, find support there, depending on how strong the support is, either continue with this consolidation right here between 97,500 and 95,600, or drop back down into the balance down here. So far, I'd say it's most likely that we will stay up here. And that's what I think you need to know. All right. So with that, we're going to end the stream. Thank you all for being here. It's a bit of a shame that the connection at the end was not that great. At this point of time, it should be good, but still, I mean, I can see quite a lot of people tuned out, which I definitely understand. I would do the same. But couple of things. First of all, make sure to join the free Telegram, free Discord will be down in the description. If you're interested in trading signals, and right now I'm building a full trading guide on cilinix.com as well, check out the signal group, but that's up to you. If you're interested in that, then that might be something worth looking at or worth going after. But for now, that's it. And like I said, I'll see you all in my next videos tomorrow morning. Let me know if there's some specific coins you'd like to see analyzed. But for now, that's it. So thank you all for being here. Thank you all for watching the stream. Hopefully it was valuable for all of you. And indeed, it's Champions League, so we're going to watch some football. Thank you all. I'll see you all in my next videos. Take care. Have a great evening, and I'll see you